What's good, YouTube? It's OTG back at it again, day two into the trading journey. So here we've got Rayner Teo, a big Singapore trader in Forex, and this is basically his YouTube channel. And as you can see, he's very big on YouTube. He's managed to beat the algorithm and become one of the very few successful YouTubers in the Forex space. And I think from all the YouTubers that I've seen, he has the most subscribers in the industry of Forex. As an individual, that's Rayner Teo. And as you can see, 717,000 people engage in his content. So he's a very credible source. But we're going to go onto his website. So this is his website, tradingwithrayner.com. Tradingwithrayner.com. Link is going to be in the description below. I hope he doesn't mind that. So basically, this is the opening page to his website. Got Rayner there, great smile. What's up, my friend? You know, very welcoming. He's like, come learn with me. And just straight off the jump, he's already providing you with a lot of content, a lot of very good books that are gonna give you strategies, help you understand certain things such as candlestick patterns, etc., and provide you with that extra psychology. So as you can see, he's here to supercharge your trading results. He's got a community of over 30,000 traders. He's got 717,000 on his YouTube, and he's going to be providing new strategies, breaking down the markets, giving you free courses, etc. He's got a lot of free knowledge that he's giving out to a lot of people, where other people in the industry will make you pay hundreds to thousands of dollars for what he's giving you for free. So it's definitely a good place to check out after you've gone through babypips.com and you've got the basics. But he's also going to provide us with that too. So here you just click on one of these. He's going to provide you with one of the books. You just have to put your email. Yeah, he's just going to introduce himself, why he started trading, how he started trading. As you can see, he's built himself quite a trust with big names endorsing him, such as Yahoo, Forex Factory, FX Street, Finance Magnates. And here he's got other traders in his comments on Facebook just appreciating what he's given to them and how he's helped them, because he's really cutting down the learning curve for a lot of traders. So yeah, you just get started for free. Provide your email. Provide my email, but I've already got that, so I won't do that. But for those who haven't, put your email in, get some free knowledge, something that you can always go back at and look at again. So now we go into the next page on his website, and to get to that page, just go to the bottom of the first page and click Academy. So now in the Academy, as you can see, there's a lot of content. He's got pullback stock trading, he's got content on stock trading, forex trading, candlestick patterns, trading terminology, trading view tutorials, trading strategy, price action trading, trading tips, indicators, chart patterns, webinars, and then at a price he's got proprietary trading indicators and a back test research lab and weekly trade alerts. So a lot of free content, but for us, since we're just getting started, those of you who don't know who Rayner Teo is, it gives you an opportunity to understand how he analyzes the forex market and what he sees when he's looking at the charts. So yeah, as you can see, he's got videos, but at the same time he writes down his content. So those who like to read instead of learning from hearing and watching a video, it's gonna help you. So basically, breakdown of what is forex trading and how does it work. And forex trading is simply the trading of one currency for another. This is something that I would say 99% of us have dabbled in, and yeah, that is accurate. The only people who probably haven't dabbled in it are babies. So yeah, so let's say I'm in Singapore and I'm going to Malaysia for holiday. I wanna go to Malaysia for holiday. I need to spend Malaysia ringgit. In order to get Malaysia ringgit, I need to sell my dollars, my Singapore dollars, for Malaysian ringgit. This is forex trading. Sell your own currency for another. So forex is largely traded by central banks, corporations, retail traders, and we fall into right here. That's us, retail traders, small individuals, right at the bottom, and we always start from the bottom, but you know where we're going. So central banks are usually meant to intervene in the FX markets. In 2012, you have the Swiss franc pegged against the euro because the Swiss franc was appreciating too much against the euro, and the central bank intervened and pegged the euro to 1.2. This is an example of central bank intervening, manipulation, etc., etc., by the big players, but that will never stop a retail trader from making bank. Then you got the banks, that's the Deutsche Bank, Goldman Sachs, HSBC. They trade, but as a form of providing liquidity. Then we have corporations. These have a close working relationship with banks. So that's like Toyota, Audi, any big corporation you can think of. They have a close relationship with banks because in their industry they're trying to export and import raw materials. So and they're doing it in bulk, so they're going to need foreign currency to, to export, etc. And they're going to need that relationship with the bank to get that foreign currency readily available in large amounts. And then we have retail traders, that's you and I, who speculate in the markets to earn a profit. And that's probably why you're watching this video right now, as Rayner Teo. And that is why we are watching it. We want to make a profit, we want to learn a new skill. So it's just got a breakdown here. You can pause that, take a picture, and understand how money is moving through the different types of traders. So you can see that the central banks are the largest, followed by the major banks, and then so on and so forth. On top of that, you're gonna have your market makers and your brokers. And for retail traders to trade, we have to go through a broker. You can't just put money into the foreign exchange market. You have to go through a broker. So as I explained in the other video, that's something that you're going to have to do your research on later. And in a later on stage, I will be providing you guys with top brokers that you can decide to invest your money in, and make sure they're always regulated so you never have a problem with taking your money out. So that's the forex hierarchy. Breaks it down to us. It gives us a colorful pattern scheme, so that as you're reading it, it really sticks in, and hopefully your subconscious registers the colors. So as you can see, the source is babypips.com. Babypips is the go-to place for new traders. So you can see he probably went there because they probably give the most basic explanation, but I feel like he's breaking it down even further, and hopefully I can break it down even further. the advantages of forex trading. And in this case, let's just say, what are the advantages of forex trading over other forms of trading? So the advantages are high liquidity because we're dealing straight with cash. We're not dealing with stocks. We're not dealing with crypto. So taking money out is never going to be a problem. Second, there's a low barrier to entry. So there isn't much stopping you. As long as you have a phone, an internet connection, and a bank account, you're good to go. That's all you need. And when you identify your broker, there's some brokers that will allow you to put in $10, and some brokers that are going to allow you to put in a minimum of $100, and some that are going to say 500. It just depends on your broker. But as you can see, even with $10, you're going to be able to start. Then 3 is going to teach you how to manage your accounts, how to manage your risk, and that's something that's going to help you in everything that you do outside of Forex as well. For example, with the PlayStation 5 coming out right now, I know right now, for me personally, it's not a dire thing. I've got a PlayStation 4, so I don't need to get a PlayStation 5 right now because I know right now it's at its highest price. But at some point in the markets, it's going to touch and retest and drop, come back down. The price is going to get lower. That's when I'm going to buy. And then it's going to go back up again. And that's just basically how markets tend to move. And then it's got low transaction costs. So when you make your trades and you make your profits, you're gonna get most of the money, and very small percentages are gonna be taken off. So I'm sure that's what he's been explaining. So when we go into better risk management, trading in forex market allows you to trade very small lot sizes. You can trade up to a micro lot, even a nano lot. These are really small lot sizes that allow you to better manage your risk, unlike stocks. For example, you buy one share of a blue chip stock, in Singapore to buy at least one lot of shares is at least 1,000 shares. If your account size is too small, you can't even buy one lot of shares in Singapore. Compared to Forex, you have better risk management because they let you trade really small sizes. So another big advantage, trade any time you want, is 24/5, Monday to Friday. So let's say about Sunday night, depending on which time zone you're in. Since he's in Asia, for him it's Monday, but for the rest of the world, it's from about Sunday night to about Friday night. So it's 24/5. So just Friday night, no trading. Saturday, no trading. Uh, Sunday morning, Sunday afternoon, no trading. Then the rest of the time you can trade at any time you want. Low transaction costs, and that's basically an introduction into Forex. That's basically the juice. That's the juice right there. All in the space of what? A 10-minute video. So from here, this goes on to what are the major currency pairs. We all know what the major currency pairs are. If you don't, go to babypips.com or just look at them right here. And those are the 7 major currency pairs. Well, 7, 8 just depends on your source. So just a breakdown of the currency pairs. You just need to know what the currency pairs are. Then you know the cross currency pairs. These are basically major pairs that are not correlated with the US dollar. Then you have the exotic pairs where you have one currency against another, mostly in developing countries, e.g. South Africa. You know, that's the South African rand, the Mexican peso, the etc., etc. I wouldn't trade those because those don't have as much volume as the major currency pairs. Always stick to the major currency pairs. So when is the best time to trade Forex? So yeah, it's gonna break down the sessions that we got: the Asian session, the London session, the New York session. This is pretty much a run around the clock. Asian to London, London to New York, and New York back to the Asian session, and so forth in a loop. So when does the trading session schedule change? That's summer period, April to October, winter period, October to April, daylight savings. I'm sure you guys know that. And this is gonna basically just show you the the time periods. So what is the best time to trade Forex? Well, this question is for day traders. If you're a swing trader, then it's not really that important because you're trading over a long period of time. And if you're a long-term trader, it's also not important because you're trading over a long period of time. But if you're a day trader who's trying to get on the charts every day, then you're gonna need to know the best times to trade, particularly the opening and close of the market, and when sessions overlap. Those are the best times to trade because of volatility. So for London session, for traders who want volatility, the London session is the best because you have the greatest number of transactions. To be even more precise, that's the London and New York overlap. So that's when all the traders in New York, from all the movies that you've watched, when you see people in New York in a skyscraper, Wolf of Wall Street type shit, those are the niggas. That's the time they're getting into the office, and you can see those niggas already charged up. So the London and New York session is open at the same time, so it's a good time to trade because of volatility. As you can see from the graph, look at how the market was moving before, and then in anticipation of the market opening, look at that. And now the market is open, spike, spike, spike. Look at that. Look at that highest volume whilst the market is overlapping. So what is the best day to trade Forex? And this chart is going to just basically show you the best days to trade, and that's particularly as you approach the weekends, and that's Thursday, Friday. Those are good days to trade. Tuesday as well during the week, but in general, Sundays when the market opens, it's usually quiet. Mondays, probably people still coming from the hangover fix, slow down the job, so not a lot of volume, but there are always opportunities to trade, but never force a trade if there's no volume that day or there's no momentum. So just to recap, there are three different trading sessions: the Asian, the London, New York. The London session is a volatile trading session where you have a lot of transactions coming through. This at its peak, that's the London and New York overlap session. That's the peak time to be trading. And the most volatile days are Tuesday, Wednesday, and Thursday for most currency pairs. So now we just go down into common trading common trading terminologies. And this is for those of you who are brand new to Forex, still discovering what longing, shorting is, leverage, margin, bid, and ask, spread. So long, short, in basic terms, long is to buy, short is to sell. To simply put it together. So if a trader says, hey, OTG TAF, long Euro USD, that means this trader will make a profit if the price goes up. So if people buy the US dollar, I'm gonna make money. If people buy the euro, I'm gonna make money. And a bullish movement, and bullish means that's a positive movement. I'm making money. A bearish movement means I'm losing money. That's a negative movement. So in a negative market, I would want short. I'd want to go short, which means I'd want to sell my currency in anticipation that it's going to get weaker as compared to the currency I'm comparing it against. So it's either you're bullish or you're bearish. So long means you're bullish, short means you're bearish. And you can make money in both times. So leverage basically, and margin leverage, it basically means how much larger you can trade relative to your account size. So that's one thing with Forex is they give you leverage. So even if you have $10, you can basically be trading with, like, let's say $1,000 account because of leverage. But then at the same time with this leverage, there's more risk. So you could make a lot more money. With $10, you could potentially make $50, but at the same time, you could wipe out your whole account and lose all your money. So if you have a $10,000 account and you're using crazy leverage and your trades go wrong, you could lose all that money in the space of one trade or a few bad trades, and at the same time, you can make a lot of money. But it's better to just be in it for the long term, because we trying to trade, we trying to make this our job. We're not just trying to get profits and get out. You want to actually learn how to do this. So that's basically what leverage is. He basically tells us what it is, that our broker, it's not really physically giving you money, but he's letting you trade with that on his account basically. It's on your account, but you're trading through his platform. So that's basically leverage. And then your margin. So essentially margin and leverage, they're two sides of the same coin. You can apply this formula. Just take 100, divide by your leverage factor. So we spoke about a factor of 1 is to 50. That's the ratio for calculating your leverage, as you can see here. And then that'll give you a margin in percentage terms. So it'll basically help you with your risk management so that you know how much you're risking. And then now we have a pip. Pip, everybody needs to know what a pip is. Basic terminology. And it basically refers to the point in percentage. Pip, point in percentage, PIP. And it's the smallest price movement in the market. So for most currency pairs, the pip is the fourth decimal place. For the yen pairs, it's the second decimal place. This is something you have to know. So let's talk about Euro USD. Euro USD is trading at 1.012, and let's say it moves up to 0.0 into 1.0015. So it's just moved about 0.03 pips. So that's basically how you're calculating how the market moves. That's basically how you're calculating how you're making your money. So with the Japanese yen, the value is at the second decimal place. So let's say you're trading at 1201 and it moves up to 1205. You moved 4 pips. So remember for the yen, you're looking at the second decimal place. And then the bid and the ask. What is a bid and ask? This can be a little bit tricky because it depends on what market you're trading. But we're just going to look at it in terms of the Forex market. And the bid is basically the price you can sell it at. The ask is the price you can buy it at. So one thing to know about the market is there isn't exactly one price in the market, where there's two prices. So let's say you're getting Euro USD. The ask is 1.0015, 1.0015. The bid is 1.0014. So if you're on a sell right now, you sell it at the bid price. If you're on a buy, you buy it at the ask price, depending on your trade direction and what you're being offered when you're trading. And then the spread. The spread is simply the difference between the two prices. So that's something that you're gonna be paying off through your broker. So it's just something that's important when you're now taking out your profits, that you understand this before you decide to sign up for a brokerage that you don't even know what their bids are, what their ask price, what their spread is, what their commissions, etc., etc. It's just something that you should know. You get better platforms, but maybe they're taking more of your money out. So, and if you're losing, that's going to be hurting you. And then finally, before we end the video, we're just going to go to lot size. So a lot size basically represents 100,000 units of a currency. So let's say you want to buy 100,000 units of Aussie US dollar, you're going to be buying them at $1.20. You'll receive 100,000 Aussie US dollars, and in return, you're going to be paying for 120,000 US dollars. So we got the different lot sizes: the standard lot, 100,000 units; the mini lot, 10,000 units; the micro lot, and then the nano lot. And depending on your broker, some will provide this and some will not, but most will provide a micro lot, mini lot, standard lot. So just to put things into perspective, got this, and it breaks down how the lots are calculated. So as you can see, 100,000 equals to one lot, 10,000 equals to 0.1 lot, depending on how many units you've bought. And that's going to be something that's very important when you're now doing your risk management, is that you're going to have to calculate your lot sizes in order to prevent yourself from losing a lot of money.